Well, good morning, good afternoon, or good evening, depending on when you're tuning in. It's always good to sit down and just talk a bit about investing, about life, and about the things Charlie and I have learned over the years here in Omaha. I'm 94 now, and I've been at this game a long, long time since I was a little fella delivering newspapers back home. And if there's one thing I've learned, it's that this business and frankly, life itself is a whole lot simpler than most folks try to make it out to be. They try to add layers of complexity, but the real gems, the enduring truths, are usually staring you right in the face. It's about sticking to the basics, really. Let me tell you, though, the path to understanding those simple truths wasn't always a straight line. I made more than my share of bonehead mistakes, big ones, the kind that cost you not just money, but sleep, and the kind that etch themselves into your memory. One of the biggest and perhaps the most foundational was Berkshire Hathaway itself. Now, some folks might scratch their heads at that, seeing what it's become. But the truth is, buying into that textile mill back in 1962 was a monumental error in judgment, one that cost our shareholders many, many billions of dollars over the decades. I mean, if I hadn't made that initial mistake, if I'd simply put that capital into a different, better business from the start, Berkshire would likely be a far more valuable company today. What a dumb decision that was. I was running my partnership in the 1960s, and I saw Berkshire Hathaway, a New England textile manufacturer, trading at what seemed like a bargain price compared to its working capital. It was a classic cigar butt investment, a Ben Graham type of situation where you buy something cheap because it has one last puff left. I paid around $7.60 a share for the initial stake, thinking I was getting a good deal on a company with net working capital of 10. The management at the time, particularly a fellow named Seabury Stanton, had agreed to buy back shares. But then, as it always happens with these struggling businesses, they tried to lowball me on the tender offer. They offered 11.375, and I, being a hot tad, got mad. My competitive juices got flowing, and instead of taking the easy money and selling out, I decided to buy control of the company and fire the guy. What a foolish emotional mistake. So in 1965, I gained control of Berkshire Hathaway, and for the next 2 decades, Charlie and I, mostly me, I admit, poured good money after bad into that textile operation. We spent something like $20 million on new looms, trying to make an uncompetitive business competitive. It was like trying to teach a pig to sing. It wastes your time and annoys the pig. We closed down the last of the textile operations in 1985. That $20 million, if invested wisely in almost any other decent business, would have compounded into hundreds of millions, if not billions by now. It was a constant drain, a capital sponge, soaking up money that could have been deployed into truly wonderful businesses. I made that mistake because I didn't understand the fundamental economics of the textile industry. It had no moat. Here's what I learned from that mistake, etched deep into my psyche by countless sleepless nights and frustrated days. It is an absolute fool's errand to try and fix a bad business. You can have the best management in the world, the hardest working employees, and all the capital you can throw at it. But if the underlying economics of the industry are rotten, you're just shoveling sand against the tide. Ben Graham taught me the importance of a margin of safety, buying something for far less than its intrinsic value. And that's a cornerstone principle. But Charlie Munger, my brilliant partner, taught me to take that a step further, to realize that a substantial margin of safety can be found not just in a cheap price, but in a truly wonderful business. Charlie always says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The textile mills were a fair company at a wonderful price. And look where that got us. It was a business that required constant capital infusions just to stand still, let alone grow. It had no moat, no sustainable competitive advantage that would protect it from rivals or allow it to raise prices. It was a commodity business, plain and simple, and those are brutal. We want businesses that have a wide, durable moat around them, something that keeps competitors at bay and allows the business to earn outsized returns on capital for a long, long time. You see, investing is like building a castle. You don't just want a fancy castle. You want a wide, deep moat filled with alligators and crocodiles around it. That moat protects your economic castle. A strong brand, low cost production, network effects, high switching costs. These are all examples of economic moats. When you find a business with a truly formidable moat, you can afford to pay a fair price, knowing that the economics of the business itself will do the heavy lifting for you over the decades. This fundamental shift in thinking, largely thanks to Charlie, was probably the most valuable lesson I've ever learned, the one that truly transformed Berkshire. That realization, the profound difference between a business with a moat and one without, it really hit home when we bought See's Candies in 1972. I remember the initial sticker shock. It was a regional candy company in California, and the owners, the See family, wanted $30 million for it. Now, at the time, See's was earning about $4 million pre-tax. So we were looking at paying a little over 7 times earnings, which seemed expensive for a candy company. My initial instinct, honed by years of cigar butt investing, was that it was too much. But Charlie, he saw something else. Charlie looked at edges, and he didn't just see the current earnings. He saw the brand. He saw the pricing power. He saw the loyal customer base, the joy people got from that distinctive box of chocolates, especially around holidays. He saw that they owned that emotional space in people's minds, particularly in California. It was a business that could raise prices a little bit each year without losing customers, a true sign of a strong brand and a moat. And critically, it was a business that required very little capital to grow. It wasn't like those textile mills constantly needing more money just to stay afloat. So, despite my initial hesitation, we paid $25 million for See's Candies. And boy, was that one of the best decisions we ever made. That $25 million investment has now generated well over $2 billion in pre-tax earnings for Berkshire Hathaway, money that we've been able to reinvest in countless other wonderful businesses. See's taught us a lot about the beauty of a business that can generate high returns on very little capital, a business with pricing power and a durable competitive advantage. It's an example of buying a wonderful business at a fair price, and it showed us the true power of a brand as a moat. It was such a simple business, selling chocolate, but it taught us so much about what to look for. The lessons about moats and good businesses also tie into understanding human nature and how markets behave. My old professor, Ben Graham, gave us the perfect metaphor for this with his Mr. Market analogy. Imagine you own a small piece of a business, and every day a manic depressive fellow named Mr. Market shows up at your door, offering to either buy your share or sell you his. Sometimes he's ebullient, sees only sunshine, and offers you a ridiculously high price. Other times he's depressed, sees only doom and gloom, and offers to sell you his share for pennies on the dollar. The key is you don't have to deal with Mr. Market. You can tell him to scram. But when he's being exceptionally foolish, either high or low, that's when you can take advantage. A prime example of this was the American Express debacle in 1964. You see, American Express got entangled in something called the salad oil scandal. The company called Allied Crude Vegetable Oil Refining Corp., run by a fellow named Tino DeAngelis, issued warehouse receipts for millions of pounds of salad oil that simply didn't exist. American Express's field warehousing subsidiary had guaranteed these receipts, and suddenly they were on the hook for hundreds of millions of dollars. Panic ensued. The stock plunged from over $60 a share down to $35, and people were literally lining up to redeem their American Express money orders and traveler's checks, fearing the company would go bust. Well, Charlie and I, we saw Mr. Market in one of his deepest depressions. We packed up and went to New York, and I spent days visiting restaurants and banks to see if people were still using their American Express cards. I watched people in line at the bank asking if they'd lost faith in American Express. What I found was that the brand, the trust in American Express was still incredibly strong among its customers. People had faith in the cards and the checks, despite the headlines. It was a crisis of confidence for the stock, but not necessarily for the underlying business's customers. So in late 1964 and early 1965, my partnership invested about 40% of its total capital, a staggering $13 million, into American Express stock and bonds. At one point, we owned 5%. It was a huge bet. but it was based on our conviction about the enduring strength of the American Express brand and its fundamental business, not on what Mr. Market was screaming. The market had completely mispriced the company due to temporary fear. Within a year or two, the stock had more than tripled. That experience hammered home Ben Graham's lesson. Be fearful when others are greedy, and greedy when others are fearful. It's one of the simplest yet hardest truths in investing. That principle, waiting for Mr. Market to lose his marbles, served us well many times over. Take our investment in Coca-Cola, for example, back in 1988. It was a company I'd admired for years. I mean, what a simple, beautiful business, a product that's loved by billions around the world, costs next to nothing to make, and has a distribution system that's second to none. We bought a significant chunk of Coca-Cola, around $1 billion worth in 1988, which for us at the time was a pretty substantial sum. We picked up those shares for about 10.25 on a split adjusted basis. Charlie and I understood that Coca-Cola had a global moat that was almost impenetrable. Think about it. A small child in Omaha, Nebraska, and a small child in Beijing, China, both want the same thing. They want that red can, the brand recognition, the taste, the ritual. It's all there. The market sometimes forgets the power of such simple, enduring qualities. Analysts would fuss over quarterly earnings or some new competitor, but we focused on the fact that Coca-Cola could raise prices just a little bit year after year and continue to sell billions of servings daily all over the planet. It's a business that almost an idiot could run, and that's the kind of business I like, because eventually an idiot probably will. Our initial $1 million investment in Coca-Cola grew into many, many billions, and it remains a core holding at Berkshire today. It's a testament to the power of a global brand, a simple product, and the incredible long-term compounding that happens when you own a piece of a truly wonderful business and just let it sit there. Our favorite holding period, as Charlie always says, is forever. You don't get rich by constantly buying and selling. You get rich by owning a piece of great businesses for a long time. It's like planting a tree and just letting it grow. You don't dig it up every few months to check on its root. Now, a lot of folks assume that because I don't generally invest in high-tech companies, I have a fixed and narrow circle of competence that never changes. And it's true, I largely stick to what I understand. I avoid businesses where I can't figure out how they make money or what their durable competitive advantage is. But a circle of competence can actually expand slowly over time if you're willing to learn and adapt. My investment in Apple starting around 2016 is a good example of that. For years, I avoided tech. I passed on Google, Amazon, you name it, because I felt I couldn't properly value them or understand their future competitive. But Apple, that was different. Charlie and I started to see it not just as a technology company, but as a consumer products company with an incredibly sticky ecosystem and a powerful brand. People love their iPhones. They're not just phones, they're integral parts of people's lives. People will buy a new iPhone even when they don't strictly need one because of the brand loyalty, the ease of use, and the status. It's similar in a way to See's Candies in that it has an emotional connection with its customers and incredible pricing power. It's a product that has become indispensable. We started buying Apple stock when it was trading around $25 a share, split adjusted, and we built up a massive position, ultimately investing over $30 billion. That investment has now grown to over $70 billion, making it Berkshire's largest holding. It taught me that while technology itself might be outside my circle of competence, understanding consumer behavior and the power of a brand, even if delivered through technology, is not. The underlying principles of value investing remain the same. Look for great businesses with great management at a fair price that have a durable competitive advantage. Apple had that in spades. If you're a young investor today, or even an old one, the most important thing I can tell you is this: invest in yourself first. That means reading. I spend 80% of my day reading books annual reports, newspapers, everything. It's how I learn. It's how I expand my understanding of the world and of business. The more you learn, the more you earn, not just in money, but in wisdom and understanding. You don't need fancy math or complicated financial models. You just need to understand the businesses you're looking at, really understand them inside and out. What I'd tell my younger self and what I tell shareholders at our annual meeting every year in Omaha is that you don't need to do extraordinary things to get extraordinary results. Simple, consistent, rational actions over a long period will yield incredible results. Compound interest, as Einstein supposedly said, is the eighth wonder of the world. It's about letting your money work for you, letting it grow patiently. The biggest enemy of a good idea is impatience. People think you need to be constantly active, constantly trading, but actually the opposite is true. The market is there to serve you and not to instruct you. Most of the time, the best thing to do is nothing. Just sit there, wait for the fat pitch, like in baseball. You don't have to swing at every ball. You can let thousands of pitches go by. And when you do swing, make sure it's a good one. Don't feel pressured to act just because everyone else is. That's usually when you make your worst mistakes. This wisdom, these simple truths, they apply to any business, not just investing in the stock market. What really matters in business is quality of management, a clear understanding of your customer, and a strong competitive moat. We've been fortunate at Berkshire to have incredible managers running our subsidiary companies, people like Ajit Jain at our insurance operations, who are true experts in their fields and treat every dollar as if it were their own. Find great people, give them autonomy, and get out of their way. It sounds simple, but it's often overlooked. When nature plays such a huge role in business and investing, we are wired for instant gratification, for herd mentality. When everyone else is piling into a hot stock, it feels good to join them. When the market is crashing, the fear is palpable and everyone wants to sell. But those are precisely the times when you should be doing the opposite. It takes discipline, a strong internal compass, and a willingness to look foolish in the short term. But over the long run, it pays off handsomely. My dad taught me a lot about integrity and about saving, and those early lessons stuck. I remember filing my first tax return at 13, claiming my bike as a business expense for my paper route. Every penny counted, but that's not the only lesson I learned the hard way. This reminds me of another time when I let emotion get the better of me, a time when I held on to a losing investment for far too long, convinced I could turn it around. It was a partnership with some family members and friends, and we bought a department store chain called Hochschild, Cohn & Co. in Baltimore in the late 1960s. It was another cigar butt situation, a retailer in a declining industry. I kept thinking, we can fix this, we can make it work. But like the textile mills, it was fundamentally a business that was going to struggle against the changing retail landscape, particularly the rise of discount stores and malls. I held on to that investment for years, pouring in capital, trying to innovate, but the results were always mediocre at best. I should have recognized much earlier that I was fighting a losing battle and that the capital could have been far better employed elsewhere. It wasn't a total loss, but the opportunity cost was enormous. I eventually sold it, but too late. It was a good lesson in knowing when to cut your losses and admit you were wrong. What a bonehead move to persist when the facts were clearly telling me to move on. Sometimes the best decision is the one you make quickly, admitting a mistake and moving on to better opportunities. Another mistake, though not as costly as the textile mill, was Dexter Shoes. We bought Dexter, a shoe manufacturer, for $433 million in Berkshire stock in 1993. I was impressed by the management and its profitability. I thought it had a durable competitive advantage in its manufacturing process and a strong brand in its niche. Turns out I was dead wrong. The shoe industry was changing rapidly, with imports from lower cost countries making it incredibly difficult for domestic manufacturers to compete. Dexter's moat, which I thought was there, simply wasn't. Not only did Dexter's business falter and eventually become worthless, but because I paid for it with Berkshire stock, that stock would have compounded into billions of dollars over time. That was a huge, huge mistake. Giving up valuable Berkshire stock for a business that had no lasting competitive advantage, it was a reminder that even after decades in the business, you can still misjudge a moat or misinterpret industry dynamics. I'm telling you, it keeps you humble. It certainly kept me humble. So after all these years of doing this, here's what I know for certain. The enduring principles that have guided Charlie and me, and that I believe can guide anyone looking to build wealth over time. First, understand that you're buying a piece of a business, not just a ticker symbol. Think like an owner. Ask yourself what the business is really worth, its intrinsic value based on its ability to generate cash flow in the future. Price is what you pay. Value is what you get. Make sure you're getting more value than you're paying for. Second, and this is crucial, only invest in businesses you understand. Stay within your circle of competence. If you don't understand how a company makes money or what its sustainable competitive advantage is, then just pass. There are thousands of investment opportunities out there. You don't have to understand every single one of them. You just need to understand a few really well. Third, demand a margin of safety. Buy businesses at a significant discount to their intrinsic value. This gives you a cushion against unforeseen events and protects your capital. Fourth, think long term. Our favorite holding period is forever. Don't get caught up in the daily gyrations of the market. Most of the news is just noise. Focus on the underlying business fundamentals and let compounding do its magic. Patience is a virtue, especially in investing. And finally, avoid debt. I've never borrowed significant money personally or for investment purposes at Berkshire unless it's very conservative and against extremely safe assets. It can destroy you when things go. As Charlie says, the first rule of compounding is to never interrupt it unnecessarily, and debt is a sure way to interrupt it. I'm 94 now, and if I could tell young investors one thing, it would be this. The greatest asset you have is time. Start early, invest regularly, and let compounding work its magic. Invest in low-cost index funds if you don't want to spend the time researching individual companies. But whatever you do, be patient, be disciplined, and avoid the noise. Never forget rule number one, never lose money. And rule number two, never forget rule number one. That doesn't mean you won't ever see a stock go down. It means being thoughtful about what you pay and what you buy so that the odds of permanent capital loss are very, very low. I'd never bet against America or against human ingenuity. The future, for all its challenges, remains incredibly bright. Innovation, progress, and the free market system have lifted billions out of poverty and continue to create amazing opportunities. You don't need to be brilliant. You don't need inside information, and you don't need to predict the direction of the stock market or the economy. What you need is a sound intellectual framework, patience, discipline, and the emotional fortitude to stick to your principles when others are panicking or getting carried away. Those simple habits applied consistently will serve you exceptionally well.